And my goal here is to motivate sort of what are the foundational scientific concepts that drive the digital landscape, and therefore, what does one do with that, right? And it's obviously, as I mentioned before people joined, that this is our strategic view of the landscape and one specific approach towards it. My hope is we have a vibrant conversation and see if there are collaborative opportunities for us to change the fabric of digital, because that needs to happen. It needs to happen very, very quickly. So that's my planned presentation for the day.
Siva, that's perfect. So let me kick it off for those that may not be familiar, but I imagine everyone is. I'm Larry Pruss. I'm the host of Tech Talks. We've been doing this for a while. Our podcast or our kind of open conversation is always at the intersection between traditional finance and emerging fintech or emerging technologies. So digital is what we're going to be talking about today. Siva, I'll let you do your introduction, but it's funny, we've now had, at the last Tech Talk, we had two individuals from MIT. I believe you're from MIT as well. So
Yes.
I see a trend there, certainly in technology, which is not a surprise. But as I mentioned earlier, everything is going digital. Money's digital for anyone that's been paying attention. Bitcoin just hit 100,000 plus today or yesterday. Knowledge and intellect is going digital. You think about artificial intelligence. Identity is starting to go digital. We've already had music and video digital. And with those things going digital, our world gets much smaller, communications gets much easier, things get less expensive, but to some degree, things can get more complex as well. And so we're going to talk today about banking going digital, and Siva is going to take us through a number of the laws. When we talked on the phone the other day, you'd mentioned, I think it was Moore's law, Huang's law, and Nielsen's law. I honestly knew Moore's law, but I had to look up the other two, which is Jensen Huang. I know who that guy is. So it wasn't a surprise that he's got a law after him. In Nielsen's law, that you can describe what those are. But world is moving very quickly, and so I want to introduce you to the group as a CEO of Tyfone and Payfinia, which I believe is a Kuso, and you can talk about those. But I want to turn it over to you. We'll have a great open conversation. Again, we are recording this. We'll make the recording available probably by Monday. We'll try to get it out as soon as possible. If anyone has questions, feel free to ask. Put it in the chat. I'll be monitoring the chat. And then we'll leave some time at the end for questions as well. But with that, I'll turn it over to you, Siva.
Larry, thank you so much. Yes, you're right. I am from MIT. My funny way of introducing myself is I am a certified pocket protector wearing geek. Usually, when I'm in person meetings, I follow that by saying, but I learned to wear pocket squares. So that's my background. I have a PhD in electrical engineering and computer sciences. Was in the CTO's office at Intel inventing. So I have about a couple hundred patents at Intel, and then started Tyfone with another gentleman from Intel to invent technologies for financial institutions. I'm a big proponent and a beneficiary of credit union movement. Since I moved to the country, I've been a credit union member all my life. Ended up serving on the board of Oregon's largest credit union called On Point Community Credit Union. And now I serve on the board of the Federal Home Loan Bank of Des Moines as a cooperative ecosystem. I love building tech, problem solving, but coming to the digital technologies, computes, how fast computers are going to become, how much more powerful they're going to become, fundamentally changes everything, right? So what we've done in the last several years is to really predict where things are going to go based on some fundamental laws. And what we are seeing is digital banking sitting today and looking back in the rearview mirror versus what you need to look forward. We're calling it the digital banking plus approach. You need more than what you've traditionally done. And that's what I want to motivate here. So the way you need to think about digital banking, I'm sure when you talk to various technology enablers, we often talk about roadmap, right? Roadmap typically considers two things. What are we delivering today, and what are we doing to embrace tomorrow, right? And if tomorrow is 3 years out, you can guarantee you're going to be wrong, right? So tomorrow is literally 2-3 quarters, right? Then you almost have to look at shaping the future, which has to be 5 years plus out, right? So that's how we believe technology needs to be built, because if you really look at the technology life cycle, 25 years ago, computers, remember how computers are built fundamentally affects what digital is, right? 20 years ago, it would take 3 years to design a computer system that lasts in the market for 5 years. Today, computer systems take 6 years to develop and it lasts in the market for 6 months, right? So you don't know what surprises are around the corner. So you have to really have predictable roadmap for the next year. And then you have to have multiple path finding efforts, as we call it, to find the paths of the future. And how do you do that, right? You can't do that just sitting in a room and coming up with concepts. You really almost need to have some empirical scientific models, right? So that's really how we think about it. You need ability to deliver needs of today and have plans for the next couple of quarters that are very predictable. And then you need to really have shaping the future type innovative concepts that will be risky. Our metric is 70% of what we predict needs to happen in the future should happen. We are allowed to fail 30% of the time, right? So that's really how we think about digital evolution, right?
Siva, if I can ask, when I think about predicting, it used to be you could look at the past and you kind of trend line it out to what the future is going to deliver. But that doesn't work today anymore, because literally technology is so changing so quickly. If you looked at technology a week ago, it's already outdated. So how do you make those kind of predictions just in an environment where technology in our world is changing so quickly?
Yeah, so that's a great question. So there are basically three things one has to do, right? One is look at the technological evolution prediction based on the past. But you also need to really look at new laws that come, right? There are a lot of exponential laws that you don't pay attention to until they've grown 30 times over the last 5 years. And then suddenly it looks like, oh my God, that's important, right? So what we do is, apart from extending laws of the past, like Moore's law, we have research teams that look at areas of expertise that has nothing to do with Moore's law. That's how the Nielsen's law and the Huang's law impact us. So that's the technological view. The second view is, what are the pain points credit unions members face, right? Forget the technology. What are the pain points? And then the third step is, us as consumers, when it comes to money, don't really like dramatic changes, right? We don't ask ChatGPT to move our money, right? So what we need to do is take these two aspects of technology and user expectations and make very small adjustments on the user experience. We cannot make abrupt adjustments, because abrupt adjustments are made by the likes of Apple that spend $16 million a year on UX research just on iPhone, right? So the way we have to absorb all of this is leverage these know-hows and make small changes, small and quick changes in the marketplace. And the only way we do that is we have to collaborate with our customers. So everything that we've done that has been successful, the 70% success rate in our inventions, have been things that were not hammers looking for nails. That has been things that we co-developed with credit unions, which is why we launched QSOs, right? So hopefully that answers your question, Larry.
It does, and it probably speak to that, and I'm sure you'll mention this, but I think I've got this fact right, is that you partnered with a credit union to launch be the first credit union that launched FedNow in the marketplace. Is that right? That was
Yep.
I think first credit union or something out of
Star One Credit Union.
Star One. That's right.
Yeah, I'll show you I'll motivate why we did this and how we were able to predict it. I'll also tell you that we're only correct 70% of the time. We have about 140 inventions at Tyfone. Not all of them are useful. 70% of them are. And I'll motivate how we did that prediction. One of those 70% examples, which will be Star One. So you just bear with me. I'll get there in a couple of minutes.
Sounds good.
This is really, there are very specific laws that reshape the digital landscape, right? Let me motivate it by showing the computer of the past and the computer of the present, right? I'm sure all of us use the one on the left at some point in our lives, and we all use one on the right, right? So that is a stark difference. The way to think about this is, Andy Grove, who used to run Intel when I was an employee earlier, young engineer there, used to use this analogy. If computer scaling, the speed at which computers scale, the power efficiency, and how many things you could do with it were applied to the car industry, you could now buy a Rolls Royce. This is 20 years ago. You could now buy a Rolls Royce for $10 that'll run 70 million miles a gallon, right? So that's the power of computing. This is what has driven digital banking, right? Because what was only available for Citibank as a multinational bank with computers that are sitting in their mainframe back office can now be enabled at significantly lower cost. Computer costs come down 11% every year, right? So imagine what happens over a 30-year period, right? So that's what's enabled digital banking to be what's on the left. Viewtron, which was launched by AT&T, as predates AOL, they dictated what happened to the computer screens. They decided whether you got to see your credit union's banking app or not, which obviously none of you had, right? Only a small handful of institutions could even afford to work with AT&T to enable it. By the way, this worked on a TV, by the way. It's a set-top box that you connected to your TV in the late 70s, early 80s. And then on the right side is companies like us, enable digital banking for a $50 million asset size institution with feature functions that are way ahead of the industry than even big banks. For example, the point that you made, Larry, when we launched FedNow, the very first transaction on the FedNow network was not from a big bank, was not from a fintech, was from Star One Credit Union, right? And not only that, the second credit union that went live was a very small closed charter credit union for Alaska Airlines pilots and flight attendants. Alaska Air Group, which I'm sure I'm allowed to say, did not even do ACH origination, right? They now do FedNow Send, right? Well before some of the big banks. So the power of computers is that the computes have become a lot more accessible, a lot more powerful, which is what driven digital banking all this while, right? But I think there are going to be shifts coming into the market, and our, the plus strategy relies on this. Let me sort of visually show you what Moore's law looked like, right? Imagine, in our world, an average digital banking contract relationship is about 10 years long. So in a 10-year period, computers are 30 times more powerful. So if your platform hasn't changed in 10 years, you are way, way, way behind. So how do you solve it? You have to take stair steps almost every single month, unfortunately, or fortunately, depending upon which side of the equation you're in. Now, what's happening is this law is being dwarfed by other things that are adjacent to it. For example, let's consider the speed of connection, right? Today, when I use digital banking to move money, I pay my loan Friday morning, it shows up Monday morning, right? Like, why? I expect payments to happen instantly. Networks are 70 million times faster, right? So every 10 years, if you were to look at a 10-year horizon, the network speeds are 60 times faster. So since ACH was launched, networks are real time, right? A car can make a decision to make a left turn, but our money takes 3 days, right? So this is the law that we relied on and made investments 6 years ago to say instant payments is the outcome of faster networks, and here is why. Remember, all of our payment methods to date are what are called as pull payment. Pull payment is basically when you go to a store, you can't promise the merchant, oh, my bank will move you money, and they'll be like, okay, where is it? So that's why you leave them your identity, so that way they can pull money that may come next business day, right? But networks are so fast that I can actually push money to the merchant and they can verify it within seconds, right? That's the real-time power. So we basically started investing 11 years ago, and then the FedNow, Federal Reserve Initiative, got stopped by the big banks for good reasons. And then when the Federal Reserve reinitiated that effort about 6 years ago, we started working with Star One, and that's what allowed us to be the very first platform to send money, because we built fraud controls, all of that from the ground up. Because one of the things that myth about instant payments is instant payments equals instant fraud. And don't send money, just receive money. If everybody is receiving and nobody's sending, who's receiving, right? So we made a bet with Star One, and a lot of credit goes to them to say, okay, no, we have to solve send. So one of the things that we looked at is, mobile phones are not more mobile cordless phones, right? They're just fundamentally different. You build it from the ground up. Instant payments, that is push and 24/7, 365, and instant authorization and instant settlement is not the same as even faster same-day ACH. You have to build it from the ground up, right? So that's what we did. So based on this prediction of Nielsen's law. Now, the next step, these two laws are dwarfed by Huang's law, which is basically predicts these special purpose computers every 10 years will be 300 times faster. Depending upon who you ask, it's between 100 times and 1,000 times. Huang himself believes it's 1,000 times every decade. But let's be a bit more tempered about it. We'll do one of the square root functions and say it's 300 times faster. By the way, this is real because a general purpose computer that's in our pockets needs to be able to do a lot of things well. Special purpose computers like matrix multipliers that are used in AI or GPUs, graphical units, they only do matrix multiplication. So, general purpose computers need to be a scientist, needs to be a swimmer, needs to be an artist all in one, so it can kind of do all things okay, while AI computers only do matrix multiplication. They can do really, really efficiently, right? So these are the things that fundamentally affect what we need to do. So we look at this as the Moore's law is digital, Nielsen's law is plus instant payments, and Huang's law is plus intelligent banking, right? Now, you might say, okay, what does all of that mean, right? And I want to really motivate this with a couple of visuals and a couple of demos, right? So if you really were to look at what this means collectively, all of these laws mean, is if we just take Moore's law and Nielsen's law, basically highly connected compute devices that can be more and more intelligent. Here is a visual, right? On the left, we see this, early beginnings of the internet with rudimentary connections, a bit of constrained innovation with technology, bulky terminal screen, flashing green text in most cases. And there were some data connectivity through very specialized networks, not even dial-ups, that was connecting various DARPA at universities for messaging, right? It was a researcher messaging a researcher. And then on the right, obviously, we live that war, right? Your smartwatch can probably do a lot more than some of the computers that did computing a while ago, right? So connectivity and device speeds and costs too, right? Because computer costs come down 11% every year, is what's driven the left to move over to the right in a very evolutionary manner. It looks like a revolution because it's exponential. It's like compounding of money, right? You don't wait to compound money 10 years later. You got to make it work every single day. And that's what has enabled digital to evolve from the left to the right. Now, of course, this has gone even beyond that, right? These are our new computers on the right. On the left, you had a very functional transportation system. On the right, you really have an urban environment enabled by smart devices, right? So this is sort of the evolution of, if you were to think about connectivity and speed, so you can make real-time decisions. Now, I do want to share something that's highly unique. So this just talks predominantly about the first two laws. The third law, Huang's law, makes everything extremely different. It's very unique. It's never ever happened like this before. So let me motivate that with an example. So here is a prompt to Google's image generation model. By the way, while OpenAI and Anthropic own the market in certain segments, a true innovator in large language models and machine learning and deep learning is Google, right? So this is Google's, you prompt this, portrait of a photo of a kangaroo wearing an orange hoodie and blue sunglasses, standing on grass in front of the Sydney Opera House, holding a sign on the chest that says, "Welcome, friends." So this you give to a computer model, right? What does it do? It does this. Okay? This is a given computer model, a given computer prompt generates this. It probably doesn't look like a kangaroo. It's certainly kind of wearing blue glasses, maybe a hoodie. That's certainly not Sydney Opera House, right? Now, what's interesting, again, this has never ever happened in computer history. The same model, the same prompt with about 100 times bigger computer at the same instant. This is not 20 years later. It is today. You go from 350 million compute points, or what are known as parameters. We can talk about what they are. It's just number of values in a matrix or combination of matrices. You go from 350 million parameters to 20 billion parameters, and this is what you get, right? Same model, same software basically, same input, same prompt basically, vastly different output based on how big your computer is. This is not, again, 20 years later. This is exactly at the same instant. This has never happened before, right? So by the way, if you're interested, this is sort of what the evolution looks like, right? Various parameters. And so how do you stair step it, right? Because this is not something any digital banking vendor can do, because what takes to build this is billions of dollars, right? Not a single digital banking vendor can do, not even a large bank can do. You really have to collaborate in the market to enable this, right? So what we've done is to sort of take those stair steps. So let me show a couple of quick examples. And if it's okay with everybody, I'll show the instant payment example first, so we can all be comfortable about the Nielsen's law that I talked about. And then I'll show you what we've done with the impact of intelligence and what does that mean for digital banking, right? Let me pause for a moment before I get my demo ready. And while I'm getting my demo ready, I can answer any questions if anybody has.
And feel free, I muted everyone, so feel free to unmute if you have a question there. I guess one question I've got for you, Siva, while we're waiting, for the credit union that you implemented, FedNow, I know you've done a bunch of those. Was that both send and receive? And you talked about, like, a lot of credit unions and community banks, when I talk to them, they're very interested in receive, but they're not so interested in send. But the reality is there's a whole economy out there that needs that send functionality, right? The gig economy, and it's a competitive advantage if you have it. And soon enough, the customer and member expectations are going to be such that if you don't have that capability, you're not going to be the financial institution of choice. So I think a lot of financial institutions, while they understand, yeah, I want to receive deposits, I don't necessarily want those deposits going out instantly. And they may say, yeah, it's because of fraud. But the reality is, we know that fraud, that the limit of that fraud is pretty low. I mean, really have not seen that much fraud with FedNow or real-time payments. And part of that is just because of the type of payments they are and what they're being used for. But maybe you can talk a little bit about, send versus receive as just as a primer.
Oh, absolutely. I'll do that, and then I'll show an actual send. So yes, you're absolutely right. The value is actually in send. Yes, it's important to receive money, no question about it. But the actual value is send, and here are the reasons why. It is a fundamental tool for cash management, right? Both for individuals and businesses. 67% of our members live paycheck to paycheck. So if they have to pay their bill Friday morning as opposed to Sunday night at 11:59 p.m., you're talking about 3 days worth of cash that they need to go get somewhere, right? So it's an immediate and a fundamental value add for members. If you're not sending, you're not providing that value to members. If you're not sending money, you're not funding a car loan instantly. If you're not sending, you have a wire cut off. If you live in the West Coast at 2 p.m., if you live in Hawaii, it's 11 p.m., 11 a.m. So with this is 24/7, 365. It's a fundamental value for members. And it's also a fundamental value for the operational efficiency of the institution because it's real-time authorization and real-time settlement, which means reconciliation is not needed, right? The transaction message is the money. So a couple of data points. We actually, as a couple of weeks ago, for Star One, we moved 34% of same-day ACH to FedNow. And I'll show you how we did that. It's just a workflow change. Members don't know that they're doing instant payment. We just ask them when they start with same-day ACH. We moved 34% of same-day ACH from to FedNow at 50% lower fraud compared to same-day ACH and 4x lower fraud compared to Zelle. Because remember, this is push payment. Identity that is disclosed receives money, not where the money is. And then on top of that, we also have invented something called binding strength. Binding strength basically says, is the sender and the recipient strongly bound through prior transactions? If they are, why do I limit it, right? And is the sender trustworthy? What is the binding strength between the sender and the sender's device? And we can fine tune on a user by user basis. In fact, Star One used their corporate identity in our digital banking app to fund the Payfinia QSO of $4.5 million using the FedNow network, right? Because that particular user was trusted that their dollar limit per transaction was $500,000, right? And by the way, whether you send $500,000 or 30 cents, it costs exactly the same. And it doesn't matter how big your institution is or how small your institution is. It's the fastest, the cheapest, least fraud, and most productive. Therefore, it'll replace all methods of payment.
Siva, if I can give a personal example, because sometimes credit unions or community banks will struggle with, well, they understand the business application or the corporate application of this, but not the personal application. Another day I had to pay my daughter's tuition, and it was a pretty good sized bill, and I had to do a ACH, and my wife asked, well, why the bill's not due for X number of days later or a week later? She said, why did you do that now? Like, you're wasting all that money and interest. And I said, yeah, but I don't know that it's not going to, it takes a couple of days to get there, and they might make some, if it was a wire, they could screw it up. If it was an international wire, it could get caught up in correspondent banking. And the ability to instantly send money solves that for me, right? So as a consumer, I want that. And like that would differentiate who I would bank with. So, just a personal anecdote, but there are lots of use cases at the individual level for obviously receive, but both also implementing with send at a financial institution.
Absolutely. And that's a great example. A couple of other examples. One is what we've seen already with no advertising at Star One. Towards the end of the month, the weekend volumes have now become twice that of Friday volumes. People have just naturally recognized they can move the money later and later and later. The other example is loan funding, right? You are going to compete with the big banks funding loans via RTP, right? So if one of your members is at a car dealership and the car dealership wants to get the money instantly, and our US bank, as an example, who I'll show receiving money from Star One, as RTP, they can fund that car loan for the dealer instantly. And if you don't have that, and if your branch staff has to close those operations at 2:45 because they can't wire money to the dealer, or you have to ask your member to come to the branch to get a cashier's check, you basically lost that game, right? So we are actually building a concierge payments module to enable the institution to send money well before you ask the member to self-service themselves. So we do see that very much so. It's a fundamental differentiator. So let me show an example. So this is a live system. I'm going to log into *1. So hopefully you're seeing that. And I'll start with the demonstration of instant payments.
Right now we're just getting a blank, or at least I'm getting a blank screen here.
Oh, you're not seeing anything?
No. Maybe someone else can confirm it. No, I'm seeing your mouse move, but I'm not seeing anything else.
Okay, all right. Let me do something.
Okay.
I may have to restart my phone screen share. Do you see anything?
Just a mouse moving.
Huh. Okay, hang on. Maybe it may be because my PowerPoint slideshow is.
How about now? We're back. You were back to the PowerPoint slide. Now I'm not seeing anything.
You're not seeing my phone screen? Oh, that's interesting.
Siva, I thought you went to MIT.
Yeah, but I didn't build this computer. So let me hang on one second. I may have to stop sharing and start sharing again. Maybe that'll do the trick.
No problem. Take your time. Most of us are fortunate enough to have multiple screens deal with this problem quite a bit.
Screen.
And while Siva's pulling that up, if there's anyone that has questions or comments or just want to chat about some of what he may have said, we can do that while he's getting his technical.
How about now?
There we go. It's up.
All right. So let me log into *1. Take 2.
There we go.
And then, by the way, if you have questions, please do queue them. So I'm going to start by showing sort of the instant pay. So this is the tile of available feature functions. Slight detour. We actually built originally this to be like a traditional fintech experience where a member just says, how much money do they want to move and to who and by when, and we figure out how to do it. Interestingly, members didn't like it, even though that's what they want in a fintech experience. When they come to banking with traditional expectations, they expect all of these tiles. So we added them back, and then back in the back end, we cross-pollinated them. For example, you see instant pay and same-day transfer. A lot of members are used to doing same-day transfer. So that's how actually they discovered instant payment. So let me click on same-day transfer. So I'm in the same-day transfer workflow. We just automatically go check among all of your recipients who may be instant pay enabled right this second and who's not. So in my particular case, my corporate account that runs on US Bank is instant pay enabled. My personal account on First Tech is not. So let me pick US Bank. As a member, I may not even know I did that, right? I don't know US Bank is an instant payment network as a member. The limit is whatever the limit is. As I said, on a user by user basis, our limits go up to 500,000 because we can fine tune based on the cryptographic binding strength. Because money is moving from my personal account to my business account, my auditors don't like me moving too much personal money. So can somebody give me a random number below $2? Larry, I think you said $1.50. Okay.
You're good at reading lips. I was on mute.
So I'm going to do $1.50. And then it says, hey, by the way, this recipient can receive money instantly. Would you like me to send instantly? 97% of members say yes. And that's how they eventually discovered that the money can move instantly. So the weekend volumes have become twice as that of Friday volumes. So let me say yes and continue. So what happens now is we do all of the validations, cryptographic validation. In this particular case, after that is done, I get an OTP. And one of the interesting things that we found out about OTP is it's better to tell what the OTP is for, right? Because all of us get OTPs from our credit unions and others, and it doesn't say what it's for, and we get socially engineered. Here it will say $500,000 is moving with this OTP. So you're trained to not give that to somebody. So here I'll plug in the OTP. So when I do that, let me give the narrative before I submit. Money moves from my account to the GL, master to master through our connection to the Federal Reserve, and then GL to the US bank account, all in a few seconds. So you'll see, so now it's submitting those transactions. This is why the the approach to, I think I might have jinxed it by waiting for the OTP code too long.
And see, but this is a 4-cent transaction, isn't it? I mean,
yeah,
what's the cost of a Fed? Like, which is that's amazing if you think about it.
Yeah, it's basically a 4.5-cent transaction. I mean, including the technology cost and all of this. So you should think of the cost of same-day ACH at the speed of even faster than wires, and it's 24/7, 365, right? There is no cutoff time at all. So the money is moved. So let me log into my US bank account so you can actually see that money. So I'm actually logging into a different window, and then I'll move the window over here so you can see it.
Sure.
So yeah, all of this happened with cryptographic verification of the relationship between the sender and the recipient, verification of my specific device. So here is my US bank. So hopefully you can see the web address is US bank. So a bunch of pending transaction. Here is a $1.50 transaction that we just did, right?
Yeah.
So this is instant authorization, instant settlement. Reconciliation overheads are dramatically smaller. Cash management, fraud reduction. This all happens only if you send money, right? Now, one of the things that we're enabling is not only member doing self-service send. If a member wants to fund a car loan, or you want to pay your vendors or pay your employees of the credit union, there's no reason why you can't use FedNow to facilitate those transactions, right? And we built it from the ground up. We basically focused on fraud prevention first, because that's the inherent benefit of push payment. If you don't build for it, you're not going to get it, right? That's part of the reason why you hear, oh, let's just receive money because sending is risky. Right? So that's the impact of Nielsen's law. Let me quickly show a couple of examples on how we are operationalizing intelligence, right? It's actually a lot more low-hanging fruit than you think. But before I do that, any questions for me? You find this interesting? I mean, this is instant payments are going to fundamentally change everything, right? Because the fastest, the cheapest, the least fraud if you do it right, high productivity for the institution, and cash management, member value for members and their businesses.
Hey, Siva, let me ask you a question. Is there any reason that, I mean, some of this just has to come down to technology and someone building that app to do this, but is there any reason I couldn't ultimately, when you have enough banks that are set up for both receive and send, that this couldn't be utilized for, say, paying a merchant? Because I'm thinking about like what Walmart announced with FIS. And obviously that's got implications then for financial institutions. If all of a sudden this money is being sent instantly, it all, it's not going over the MasterCard Visa rails and not getting interchanged. Like it could really be quite transformative and impactful for the industry in terms of where they're expecting revenue streams to come from today and how things work. Is there any reason this couldn't be used at a retail level for making payments?
That's a really great question, Larry. In fact, the reason why we formed the QSO and the reason why we started working with Starboard is to actually go after commerce functions.
Yeah.
Interestingly, as it turns out, it doesn't reduce your interchange income, and here is why. So Durbin Amendment, which is supposed to affect 10 billion in assets in higher institutions, actually affects everybody because that's just the way it is from a competitive point. So the Durbin Amendment has pushed on interchange income and will continue to push down every 2 years because that's what it says. The Federal Reserve Board dictates what the cost should be for interchange income every 2 years, right? So it affects everybody. But remember, the merchants are still paying the same, if not more, right? Forget Walmart. Fundamentally, your customer, community merchants, are paying 2.5% to 3%. That hasn't come down. That has actually gone up. So what's happening? What's really happening is the big merchant banks actually love the Durbin Amendment because the interchange income for the bank that takes the risk is lesser and lesser but the total interchange is the same because the merchant markup has become exorbitant. What used to be 1.5% for the card issuing bank and 0.5% of merchant markup has become 35 basis points for the card issuing bank and 2.7% markup for the merchant banks, which the QSO is going to go disintermediate. Instead of the local merchant paying 3% and you making 35 basis points, you will charge them 1.5% and they'll pay 1.5%. That is possible only in push payment, only in instant payment, because pull payment methods require the merchant bank to establish the infrastructure because they have to originate the transaction to pull money, while push payment origination is done by the consumer's bank. So we see this as absolutely changing commerce over the next decade, increasing transactional revenue for our clients by disintermediating the merchant markup for merchant banks.
Yeah, and if I can also add it, I mean, if you're a financial institution today and you say, well, I'm only going to sign up for receive and not send, if Walmart can make this thing work, and if anyone can make it work, it's going to be a Walmart. Those Walmart customers are going to start pushing on their financial institutions to have to turn that on, right, so they can make the kind of payments they want to make to Walmart. And once Walmart does it, Target and every other big merchant is going to do the exact same thing, because there's so much more benefit to them receiving those funds instantaneously versus spending a couple of days for it to finally kind of work its way through the traditional rails.
That's right. That's right. I mean, remember, for them, there is a reconciliation benefit, right?
That's right.
I think there is a question, is it realistic? Is there a decentralized payment mechanism which don't have meaningful merchant fees? So decentralized is slightly different, right? I think decentralized, the challenge is, let's take it all the way to decentralized currency. The challenge with decentralized system is if it's truly decentralized, you need to decentralize identity, information, and transaction, meaning this is me, this is how much money I have, therefore move some of it. Unfortunately, all the decentralized system is the worst of both worlds. That's why it has very limited impact in commerce. Take Bitcoin, right? Is decentralized identity, decentralized transaction, and decentralized information was the original design. But all of the wallet providers, Bitcoins of the world, Coinbases of the world, have centralized the identity, which means I can steal your identity and make a transaction on your behalf, and you can't do anything about it, right? So a true decentralized system enabling it for a US dollar is not really required. The digital dollar exercise is somewhat of a failed exercise. The value a decentralized system does bring is it's fast and cheap, which FedNow already is. So you don't need a decentralized system. Hopefully,
yeah, I think so I agree with most of what you said there. The one thing that might be an exception is if we were to see an Apple allow, say, stable coins, which is obviously kind of a centralized, decentralized, but currency-backed digital asset that could ultimately be used for transactions in a mobile wallet, just the way as you pull from a debit card or a credit card. But that's a separate argument. I follow your train of thought there, Siva.
Yeah. I think Apple, you're right. Apple has the ability to do it because they actually truly have a decentralized identity in the secure element for Apple Pay, which they are now required to open up for others.
That's right.
So the question is, therefore, are they willing to be regulated as a money mover? That's a choice that they'll need to make.
Absolutely.
So let me quickly show how we are operationalizing the intelligence framework. So I don't know how many of you remember Yahoo directory, right? When you went to the internet to search for things, you actually had a hierarchical directory that you went through. You would click on science and technology, then you'd click on science, then you'll click on physics, and then you'll eventually get to what you need to get to, right? That was Yahoo directory before Google was even there. And then we went from Yahoo to Google pretty quickly in the 90s, where instead of going through a click-through experience, you typed what you wanted, and Google gave everything that they had in some priority order. To now, with generative AI, you type what you want, and it gives you what it thinks you exactly need, right? Now, doesn't digital banking experience look like Yahoo, where you have to click through 7 things to get to what you need to get to? Why aren't we just typing what we want? It gives me what I need. So that's what we've enabled. It's not rocket science. It's called lexicon search. You program intents into a search system with a deep linked endpoint. So let's say once a decade, I do need to order a checkbook. Like, I don't have to figure out where it is. Like, I don't know where checkbook ordering is in my app. I don't know if any of you know it. In our system, you just start typing, right? And it just shows, I mean, this is what you do when you go to settings in your iPhone, right? So why isn't digital banking that way? So now, let's say I do order my checkbook at once a decade, I can see check reorder, I click on it, it auto-populates, and I'll press proceed, and I'm done. Which I won't, because I did accidentally do it the very first time I tried to show it on a box of checks showed up. So I don't need another set of checkbooks for another decade. So this applies to pretty much everything, right? Let's say I'm in my home screen and I want to do instant payments. I just start typing instant payments, and there it is. It takes me there. So every screen is one screen away, because it's all about reducing friction. Digital banking is not where a member is going to come hang out, right? It's about what do we do to lower friction for members. And then the next generation aspect is, large language models are defined through what are known as vectors. Words are mapped into a multi-dimensional space. To give you an example, GPT-3 has 12,000 dimensions. What does that mean? What that means is, so let's say, Larry, I'll pick on you. If I tell you 3 words, cat, dog, tree, which 2 things are alike compared to a third one among those 3 words, Larry?
So cat and dog being animals, I would presume.
Cat and dog being animals. But how does a machine know that? You can't program it. The way it knows it is, this is not exactly how it happens, but let me illustrate it. In a dimensional space called number of legs, cat and dog have a value 4, tree has a value 0, right? So the machine knows in the dimension of number of legs, cat is more like a dog than a tree. Large language models are actually exactly that, except it's 12,000 dimensions for GPT-3. GPT-4 is nobody knows, right? Because they haven't disclosed. So you can actually do vectoring where you can do things like this. So let me bring this screen. Hopefully you can see it. So in our current system, it's lexicon search, where if I type check, it knows what to do. But if I make a typo, if I type CHEK, I'm sure you know what CHEK is, right? But a machine doesn't. But if you train it with the large language model vector system, which actually you don't need huge computes, right? It can run on your local compute. Here, if I type CHEK, it knows the vector CHEK is close to the vector CHECK. Cat is more like a dog than a tree, right? So we've already implemented this. This is going to go live. So every screen will be one screen away, even if members don't type exactly what they should be typing. And then we're sort of taking it to the next level, where I can start asking questions, and the questions will then be taken into context. Every word will run through a vector search to determine what it should be, and then it takes those words and applies certain functions. For example, I could say things like send $20 to Larry, right? If I do that, it's supposed to, by the way, we're still fine-tuning this model, so some of the things may or may not work. So if I say send 20 to Larry, it knows send means I got to go to the transfer screen. That's my endpoint. And I need to go pick up $20 from my default account. And if I have Larry in my send list, it needs to send it, right? So here, so it picked up my default account, got Larry's account, and put $20, right? And I could, let me do a typo, right? Actually, let me change the number.
So this is all about removing friction, right? I mean, and that's one of the biggest things that we all struggle with is friction in our everyday lives.
That's right. And this is hallucination free, because one of the things that we've done is we hired a gentleman who was building sort of the AI systems for Meta to actually come help build this in our labs. So we went from what I showed you that's live, which is lexicon, to what's becoming that to vector, to now actually doing hierarchical vector analysis. All of this was done in 6 months, because the pace of development framework is also rapidly growing. So that's really how we are leveraging Huang's model to immediately impact the use cases in digital banking. So that's my story, and I'm sticking to it. And I know there are a couple more questions on the chat.
That's awesome.
We can go
Siva,
through and answer them.
just real quick, I mean, again, this isn't to sell Tyfone, but like from a competitive standpoint, do your competitors have anything like this in terms of the AI component to help take some of that friction out of making a decision around moving
Not
money
that
or
we
something?
know of. Even big banks don't have it. I think US Bank, US Bank and Bank of America have their own AI systems, but it immediately goes to a chatbot. There is a lot of research that says consumers don't trust chatbots. So we don't really want to enable a chatbot from day one. Our focus is, I really want a back and forth interaction. That's it, not a long, laborious conversation. Because remember, digital banking is not where people come to hang out. They want to do something. So we've decided that it's going to be one query, one answer. That's it, right? We also connected to CFPB language model analysis to say, if I say, what is payday loan, it'll know what to do, right? So we really want this to be question answer interaction, both ways, right? We decided that converting this to a chatbot, which some of the big banks have done, is really not the right approach to the market. And as far as we know, nobody else has this approach, including the big banks.
Yeah.
Because the challenge is when you use large language models, you have to guarantee no hallucination, right? That's really, really critical. So that's what we've done in a hierarchical. So we invented a methodology to help eliminate the hallucination with graceful failure. We've already done that for the first two demos that I showed you. We're now fine-tuning this to have graceful failure, so it doesn't. Graceful failure sounds like a negative thing. It's really to enable elimination of hallucination. Hallucination is basically when a GPT system predicts a word that it's wrong because it doesn't know meanings of words. It doesn't know what a cat is. It doesn't know what a dog is. It only knows cat is more like a dog.
It sounds like what you're doing is more complicated than this, but is it some version of like that retrieval augmented generation RAG that everyone talks about to kind of limit the responses that an AI might give based on kind of company input, or is it different?
No. So this is not to generate everything possible and then filter it. This is actually query and hierarchically make logical choices. Because if you're based on filtering, it depends on how good your filter coming out is. Coming out filters are really difficult to build because you can't, machines generate value that you can't determine the intent of. What we're doing is the other way around. We determine the intent before we even go to the machine. Sorry, we restrict the intent before we even go to the machine. So let me see. It looks like is there a real, okay, current payment functions, P2P.
If you have to go up a little farther in the chat, you'll see what the question was. I think I responded to it, but I would be interested in your response. I think they were asking about open banking impacting the form factor for some of the payment solutions that exist today that could ultimately be run over FedNow.
Yeah, that's a really great question. I think open banking is going to drive information flow first before it enables transaction flow, right? But information flow could then be used to create transactions out of band. So banking systems do need to consider it because I can check how much money you have and enable money movement outside of you, right? So you have to be mindful. Keeping that framework in mind, let's assume open banking will impact payments. Then how do you take care of it as a financial institution? It is going to affect you, right? By default, if you were to look at all payment methods, you're going to pick at some point the fastest and the cheapest and the least fraud. Even if you don't pick it, with open banking, somebody else will pick it for you, and it'll be too late for you to control it. So open banking will accelerate the decision making you'll have to do, even though 1033 is about information sharing, not transaction enablement in open banking.
So, Siva, let's see if anyone's got any questions. And while they're thinking of their question, one question I want to ask you, and it's going to be similar to one I think I saw you do an interview with Josh Datar from your team, which was, you were talking earlier about predicting the future. And since we are kind of coming towards the end of the year, what do you think the big issue that banks and credit unions are going to need to be focused on in 2025?
Oh, wow. Okay. So I think there are lots of things, right? Hopefully, we've gone past this inverted yield curve, so you don't have to worry about net interest margins. So let's assume you've gone past that, and liquidity concerns are no longer a major issue. I think the consolidation that will continue to happen, and the question is, how do you stay ahead of the market, in a positive way? Because consolidation is good in one way, and it's also challenging for providing member value in another way. So I think that determining a sweet spot is going to be important. But again, that's got nothing to do with digital. From a digital world, we truly believe if you're not on instant payments, and if you don't figure out how to leverage the network speed, instant payment enablement, and the speed of artificial intelligence computers for productivity of the institution and members, you'll be left behind. And this is not, oh, it'll happen in 10 years. I showed you the world of AI with the same prompt, with the same model, at the same time, different parameters yield different results. This is not a 30-year exercise or a 20-year. This is going to be fundamentally different 2 years from now. FedNow went from no institutions to 1,000 institutions in less than a year and a half, right? So I would say, I've drank my Kool-Aid, my tongue is purple, right? Instant payments and intelligence infrastructure, that you have to figure out what to do today, not what do I do a year and a half, 2 years from now.
Yeah, that's a great response. Okay, so let's open up. Any questions for Siva?
So if there isn't one, you have my contact information. It's my first name at tyfone.com. I do want to make one pitch in terms of who we are. We build all of these things and we think we're cool, right? We have launched 2 QSOs. We've launched a payment-focused QSO and an intelligence banking-focused QSO, right? What we are doing is our core team out of 220 people. All of their focus is going to be on building digital banking, because that's the bread and butter for all of us and our customers. But we're building dedicated teams for instant payments and dedicated team for intelligent banking. And some of the asks from our customers that have benefited from the technology, they told us how to build that we built. Our shareholders benefited from it. So one of the things that our customers have asked is, next time when you do something new with us, we want ownership. That's why we created these 2 QSOs. We've already announced the Payfinia QSO. We expect to announce the sort of the parent QSO, which focuses on intelligent banking, by end of the year. So if any of your credit unions are interested in owning a piece of the technology, please do reach out to me. Our objective is, if you look at fintechs, we all build technology, sell to financial institutions, go public, and our culture changes. It's completely misaligned with your culture because Wall Street analysts don't tell you what to do. We want to stay that way, right? And the best way to do that is to have our customers own a piece of our business. So that's my sort of last sentence pitch.
Well, that's a good pitch. We're big fans of the CUSO movement and big fans of credit unions. So congratulations on your intelligent payment and your intelligent banking CUSO launches. And with that, I do want to thank you for your time. This has been a really interesting conversation. We will get the video out fairly shortly to folks. And again, I really appreciate you joining us for SRM Tech Talks.
Thank you so much, everybody. Thank you, Larry. Take care, everybody.
Have a nice evening. Take care.
Bye-bye.